Welcome to the Scalable Real Estate Investing Podcast, where we discuss the most scalable strategies, tools, and approaches to successfully invest in real estate. Learn how to make the most impact of your time, automate your real estate investing business, find off-market deals with minimum time invested, and leverage your capital to create as many income streams as possible so that you can achieve true financial independence. Thank you for tuning in. I'm your host, Mason Clement. Hi everyone, Mason Clement here. Before we get into today's episode, I wanted to ask you one question. Are you sick of the wild swings in the stock market and ready to try something different? Did you know that investing in stocks actually put you at the very bottom of a company's capital structure, meaning that there's practically 0% chance that you're going to get any of your money back in the event that the company files bankruptcy? So basically, you're putting yourself in the riskiest position for a questionable return. Personally, I hate the unpredictability and just waking up and having half of my investment gone when I didn't do anything wrong. So what a lot of people don't know is that you can actually make higher returns on a consistent basis by investing in the opposite end of the capital structure, which is actually the safest place to be, which is on the debt side in a first lien position. And you can do that by investing in real estate, and specifically investing with my company in notes that are backed by the land that we purchase. So if you're ready to diversify your income stream, go ahead and go over to scalablerei.com and click on invest in the top right corner. There you're going to find a form that you can fill out to determine if you're eligible to invest with my company, Celion Capital, and we'll be reaching out to you to schedule an introductory call and speak more from there. So thanks a lot, and let's jump into the episode. Hi, Scalable Investors. Thanks for tuning in to another episode of Scalable Real Estate Investing. I'm your host, Mason Clement, and today we're going to speak with David Chan about his company Farm Together, which is a really interesting company doing syndications for, obviously farms, but specifically crops, trees, things like that. I'm sure David can do a lot more justice in explaining this, so I thought it'd be really interesting, though. Don't see a lot of people doing this, so let's jump into things. David, how are you doing? What's going on?
I'm well, Mason. Thanks so much for having me on. Very excited to chat about farmland and a different form of real estate investing.
All right, perfect. So, yeah, like I mentioned before we started recording, in case folks are not familiar with you, why don't we just talk about your background and what brought you to today and our conversation?
Certainly. So my lifelong passion and interest has been meteorology and climate. So that's what I studied in undergrad. And rather than pursuing a PhD, I thought we already have a lot of information about how climate is changing, and we need to really implement a lot of that knowledge in different industries, whether that be law, policy, business. I thought business was a particularly interesting one, so I made a bit of a different direction in my path, and I went to business school, but always thought about what's an industry that's going to be at the forefront of weather and climate. And I think ag is right there at the top. It's also an industry that I think not enough people are really looking at, or not enough people care about. I think we take our food system for granted, and we don't, we're sort of, we invest in arrears, meaning we're not really forward looking. We don't invest to maintain our food system. We react. So when there's a shock like COVID, we react to that, and then we make claims like, oh, we need to be investing more in supply chain, or we need to be investing more in locally produced food. But we wait for a supply shock to happen to make that investment. We don't equip ourselves and prepare ourselves as a society to be prepared for that. So I think there's so many macro changes that are happening in our industry, both globally and in the US, but some of the big ones are the fact that we do have a rising global population. We have a rising middle class that has an increased demand for more calories and also more complex calories. So calories coming from meat sources versus just leafy greens or fruit and vegetables. So I think just fundamentally, it's an industry that is experiencing extraordinary change. And I think that's going to continue for much of the century. So that's why I wanted to start my career here. I've worked in ag now for most of my career. I started in finance in an investment bank, and then helped start an early stage artificial intelligence company focused on ag analytics. Went to business school, and after business school, positioned more into investing in agriculture, both on the real asset side with PGIM, which is Prudential's investment management arm, where I invested in farmland in the US, particularly on the West Coast, and then also in agribusinesses. I worked in private equity, investing in basically vertically integrated agribusinesses that were processing ag commodities into value-added products. Ultimately, I came across Farm Together and I met our founder, Artem Milanchuk, and was really inspired by the mission and vision to make farmland a more accessible asset class for retail investors and also smaller institutional investors. And so I joined early on. I'm part of the founding team at Farm Together. And I've now been here for a little over 4 years. It's been an extraordinary journey so far.
Okay. Yeah, that's very interesting. And before we dive too much into all of it, do y'all do like livestock too or anything like that? Or is it primarily just crops?
We focus on crops. So we focus on both row crops and permanent crops. Row crops are commodities that you plant every single year. So corn, soy, wheat would all be examples of row crops. Permanent crops or permanent commodities are commodities that grow on long-lived assets. So you're underwriting a tree or a vine for a period of cash flows. Sometimes that can be decades, depending on the commodity. So an almond tree, for example, might produce economic cash flow for 40 years. So you're doing a long forecast of the cash flow of that asset. You have one single long-lived asset, one tree, and you're projecting yield off of that tree, and then obviously making projections on what commodity prices will be. But that's where we're active. So no livestock. We do incorporate some livestock in our operations here and there. So we have an organic vineyard called Vista Luna, where we actually use a regenerative grazing practice using sheep. So we'll lease sheep from a neighbor, and the sheep will mow the vineyard floor for us in early spring, which helps with a whole bunch of biological processes and is a very sustainable practice, of course. But it also helps us decrease some of our operating budget because we're not paying for fuel and a mower and all those sorts of things. So that would be the closest to how we I would say how we work with livestock. We utilize livestock like sheep sometimes as part of our regenerative practices, but we don't farm cattle or anything like that.
Okay. Yeah, I never thought about in terms of reducing overhead costs. So that's really interesting. And then I guess they could help kind of fertilize the soil as they do their business and all that. That's cool. So in terms of just identifying land, so like I previously mentioned, I focus on flipping land or looking for like large subdivide deals and stuff like this. But I think a lot of people don't really look at it like, what kind of crops could I plant on this? And so I imagine you can do soil tests, water tests, and stuff like that. So why don't you just talk a little bit about that process and what it looks like?
Yeah, certainly. I mean, soil and water testing is a good chunk of it, of course. And then also looking at both the overall climatology for a region, but then also the microclimate of the specific parcel that you're considering. So climatology is big scale statistical weather patterns for a given area. So let's say Northern California, we know that we're going to have heat in the summer. We know that these are general temperature bands. These are general precipitation expectations. And then you have that same information for every other season. Microclimates deal with specific characteristics about a given property that may influence how that property's weather responds and materializes differently than, say, another property that's at a very similar geographic proximity. So factors that could influence microclimate might be the grading of a property. So how steep does the elevation change? It could be how close the property is to a water source, say a river. It could be how close the property is to another natural barrier, maybe a heavily wooded area, or even the ocean or a bay. So microclimates are important because just because a climatology report will say this general area should experience, on average, an 85-degree day in July. If you're in a microclimate, your property's average might be 75 degrees or 95 degrees, depending on local factors. So it can change pretty meaningfully. So we would consider all of that information. Then, of course, we look at the quality and class of soil. Is it a sandy, loamy soil? Is it a clay soil? What's the grading of the soil? How much nutrient content is there? Carbon content, biomass, all of those different factors. We consider things like salinity and nematodes and all these different factors of the soil ecosystem that will impact crop yields and crop production. And once we have all that information, we can make a determination on what types of crops would be the best use of that land. Is this a good area for tree nuts? Is this a good area for wine grapes? Is this a good area for apples, pears? It's really an overall assessment. Of course, we're also considering another very important part of the equation, which is the operations. So you can have the best property in the world, but if you don't have a skilled operating partner there to farm the asset, you're never going to deliver on your full income or appreciation potential. So we have operating partners that we think are best in class, and they don't operate across the entire country. They have a very specific geographic zone that they will service. And so another factor to consider is, once we're comfortable with the climatology, the microclimate, the soil and water quality for a property, and the thesis behind a commodity group, say tree nuts, almonds, pistachios, whatever it may be, do we have a view that there are skillful operating partners who meet our level of expectation on what adequate farmland management looks like, and are there a couple of those operating partners should something happen to our preferred partner? Of course, we don't want to have all the concentration risk on just one partner. And if not, we may ultimately have to forego on that deal because we don't have that piece of the equation lined up. So it is a pretty extensive analysis on, both regions that we're active in, commodities that we're active in, and then obviously that trickles down into individual property selection.
Okay, so do you usually source the land first and then try to find a partner, or do you look at where your partner's kind of geographic radius is, like say within 50 miles or whatever it is, and then try to find land within that radius?
It's a little bit of both, because we do want to keep a pulse on transactions that are happening in our markets, even if they're outside of our geographic areas where we're active. It's just good market intel and helps us understand fundamentals a bit better. So we don't ignore those properties. We do obviously, but we evaluate those. We're aware of those and analyze them to some extent. I don't think where the difference is it's unlikely we would go all the way to acquiring a property like that if we don't have the operating partner piece in place. That being said, sometimes we source properties through our operating partners. They're the boots on the ground. They have local relationships. They find out about properties that may be coming for sale long before the market does. So sometimes we're actually able to source properties through our operating partners. And then, of course, those properties tend to be in geographic areas where those operating partners are active. So it's usually an easy fit there if that's one way that we're sourcing the property.
Okay. And in terms of like how often the operating partner needs to do something, is it every day or is it once a month, or how does it usually work when they're actually managing a property?
So it really depends on the commodity and what part of the season we're in. If we're in harvest, there's going to be daily operations happening. If we're in dormant season, unlikely that it's daily. I would say probably weekly. And then we have internally at Farm Together, we have our asset management team that's comprised of individuals who have experience in farming, agronomy, and a lot of these different domains that are relevant to farmland management. And our asset management team oversees our operating partners. So our team's in place to make sure that the properties, are being adequately serviced. They're in good condition. We basically provide an audit for our investors, an ongoing audit where our asset management team goes out and visits our properties quite frequently. I think each property is probably visited on a monthly basis. And we're able to address any issues or concerns that we see with our operating partners, should we see any. But that's another layer of risk management that we provide to our investors, having that internal asset management team to oversee, supervise, and help maintain our relationships with our third-party operating partners.
Okay, yeah, that makes a lot of sense. So, are there specific commodities or crops that y'all focus on? Like, is there like a core bundle that y'all usually do, or can you go into that a little bit more and then why you focus on those?
Yeah, certainly. So the majority of our portfolio is permanent commodities. So those would be, again, commodities that are grown on trees or vines, long-lived assets. We're very active in tree nuts, citrus, tree fruit. So examples of some of those would be pistachios, almonds. We're active in mandarins, tangos, navels, lemon, lime, and then in the tree fruit space, apples, pears, wine grapes. So pretty broad group. And excuse me one moment. And the reason why we tend to be more active on the permanent side than row, again, row crops being corn, soy, wheat, no long-lived asset. We do find there to be more alpha generating potential in the permanent space. There's just a lot more differentiation. So you could have two almond orchards right beside each other, and if one is managed at a really high caliber and the other isn't, you're going to see a wild difference in yield, extremely meaningful. One might be producing 4,000 pounds per acre and the other 1,500 pounds per acre. So really, really meaningful difference in yield. So in our role as an asset manager to our investors, we believe our job is to be able to generate alpha. And so permanent commodities are one area where we think it's just a little bit more readily available for us to make changes as a manager to generate more alpha. Row crops are a little bit more homogenous. It's a market that's heavily subsidized by the US government. So as much as 40% of all commodity income in the row crop space is subsidized by the US government. So that being corn and soy subsidies. So of course there are operating differences that can have an impact on yield, and you might have one property that's producing X bushels per acre of corn, the other Y, and there's a difference there. But those differences tend to be more muted, and we don't tend to see also on the price side a big difference for quality, because again, this is such a heavily subsidized market. Whereas on the permanent side, the difference for quality and the pricing that you get for high quality almonds versus poor or low quality almonds is again meaningful. So we think that ultimately our job, our role for our clients and investors is to deliver yield, to deliver income, to deliver capital appreciation. We are best positioned to do that on the permanent side, and that's why we tackle more of those opportunities.
Okay, and are you saying like road crops, like ROAD or ROW?
ROW, row, because they're grown in rows. So you have rows of corn, rows of soybeans. Yeah, ROW.
All right, yeah, just want to make sure. I'm just a absolute beginner looking at kind of peering through this window here, and I guess that since it's so heavily subsidized, if you don't qualify for those subsidies, you couldn't even really compete. Is that correct?
Well, it's on the row crop space, it's it's difficult to what we call direct operate, meaning you're taking yield and price risk versus lease to a tenant, where you have counterparty risk because you have a tenant, of course, but your market risk is capped, right? You have an expectation of what your base rent's going to be. That's sort of a binary outcome. You either are paid your rent or not. And the market factors are a little bit less influential on your overall economic performance, because you're deriving your cash yield from rent, not from operating income. If you are going to directly operate row crops, meaning you want your cash yield to come from operating income and not rent, generally, because the margins are very thin and it is so heavily subsidized, the best and really the only economic way to do so is to manage a very large portfolio and decrease your costs, basically by improving your unit economics. So economies of scale for row crops is really what we see as the only sustainable method for producing, adequate return. And that requires managing thousands and thousands of acres in a very specific area, which doesn't really line up well with our thesis and what we're looking to offer investors, which is diversification across different geographies, different commodities. We don't want to have all of our row crops in one county or two counties in Illinois, because while we might get economies of scale from that, we're also now susceptible to weather risks in that given region, and we don't have as many hedges on even even capital appreciation. Different states, different counties experience different rates of appreciation, and so being entirely concentrated in one area is not something that we would recommend to our investors, and not something that we want to utilize ourselves as a manager. So we like to take the lease approach, where we lease our row crop properties out to a tenant. And that gives us a lot more flexibility to have different geographies, different areas where we're investing in row crops. So we have row crops in Illinois, Nebraska, Colorado. That wouldn't be possible if we were doing direct operating, where we're looking to just build one portfolio of many thousands of acres in a given county or a very small region.
Okay, so just kind of diversify your income streams by doing a little bit of that, but you're basically just leasing out all those operations and just getting a little cash flow from the leases, what you're saying, if you do the row crops at all.
That's right. We do row crops, but we only lease them. So everything that we do on the row crop side is leased. And again, that's because the margins are much thinner on row crops than they are in permanent, which makes sense because the risk is lower. You're planting every single year versus, if you have a long-lived asset like a tree and a tractor runs over your tree and damages it, now you've affected 20, 30, maybe 40 years of cash flow by destroying that asset. So you have a different risk profile in row crops as well. So the lower returns are understandable. It reflects lower risk. But in order for us to be able to offer diversification and row crop properties in different geographies, that's why leasing makes more sense.
Okay. And when the harvest is taking place, I can just I'm thinking of a few different customers y'all sell it to, but how does that usually work? Are you selling just like big distributors, or how's it work?
So typically our operating partners will offer marketing as part of their service agreement with us. And so our operating partners will walk us through the marketing plan for a given year, and we'll approve that. And they work directly with wholesalers to time when we sell and when we contract out different parts of the harvest. We often use a marketing, I'd call it a technique or a tactic called pooling, where we don't contract our whole harvest out at one time, because obviously that would be more vulnerable to commodity price volatility. And if you happen to write that contract at a time where the price of almonds is down 7% for whatever reason, now you potentially lost a lot of the economics that could have been recouped if you had staged that out. So to mitigate risk, we do pool payments where we'll truncate that harvest out into, say, thirds, and we'll contract out a third in maybe March, and then another third in May, and then the last third in June. And this way we're smoothing out the pricing across the harvest. Obviously you can't perfectly hedge your risk, but by selling different parts of the harvest at different periods of time, we think that the likelihood of experiencing choppiness is somewhat decreased, and we're smoothing that out over time. So pooled payments are what we often use, and those pooled payments our operating partners will contract out directly with wholesalers and processors. Once we agree on prices and quality, our operating partners will figure out the logistics on how we get that harvest over to either the wholesalers, the packers, or the processors. They'll do a check for both volume and grading. So they'll look at the quality of the commodity to make sure it's at least what has been contracted. If quality is higher, we could get bonus payments on that. So there is an economic incentive to deliver higher quality commodities. And again, now we're going back to a little bit earlier when I was talking about our ability as manager to generate alpha. Those bonus payments for quality that we see in the permanent side can be very meaningful. So again, if you're doing a good job with asset maintenance and asset management and delivering high quality commodities, you can get rewarded for that through the commodity payments that the processors will pay for that quality, and ultimately for the investor that comes out into just a higher distribution and more income in their pocket. So we're able to obviously pay a bigger distribution if we're able to generate more revenue, not just for more yield, more commodity sold, but if the price point we're getting for that commodity is higher.
Okay, yeah, that actually leads me to the next question. I noticed that a lot of the offerings, or at least like the past offerings you have on your website, farmtogether.com, is like kind of like a 9 to 11 year hold period. And why is that so common?
I would say our 9 to 11 year hold period is common because again, we're dealing with biological assets, and oftentimes there might be a development component where we're planting new trees or we're buying young trees, and you can't speed up time. You can't speed up aging. Often part of the reason why our hold periods are longer is because of the aging process that's just natural and needed in a space like farmland. Additionally, these are, this is a long-term, this is an asset class I would say that you would want to invest in as a long-term investment. Farmland historically has been excellent for capital preservation. Just like any other real estate investment, there's two income streams. Two returns. There's the income return and then also the appreciation return. To deliver the most on capital appreciation, we also need time as manager to execute on certain value creation strategies that we have for a property. And that could easily take several years, depending on what those value creation strategies are, because again, we're dealing with biological assets that are outside, and often a lot of these changes will just take time. So I think that's why our hold periods tend to be a little bit on the longer side. It's not a flip it type of asset class, and ultimately when we're looking to deliver the most return to our investors, we consider factors like how long will it take us as a manager to execute on our value creation plan, and get the investor as high of an IRR, as high of returns as possible. And a big part of that is executing on the capital appreciation.
Okay, so I imagine that it depends on the property, but how long do people usually need to wait before they receive the first distributions?
Very property dependent. Of course, the development will often require a longer period of time before distributions will occur, because we're again waiting for those biological assets to develop and to produce a commercial yield. So on a development deal, it could take a couple of years for a first distribution to be paid. On a turnkey deal or a deal that we're leasing to a tenant where we're generating rent, we may expect to produce an income distribution within a year for the first year of holding. So ultimately it depends on the maturity of the property and then also the deal structure. If we're generating our cash yield from income, if it's a turnkey asset, we might have that income available within a year. If it's a rental, where we're leasing the property to a tenant, we'll have that rental income available within a year. But again, if it's a development deal, where we're waiting, we just planted new trees, we're waiting 4 or 5 years for those trees to mature and produce a commercially viable yield, then it would take that long for us to be able to be in a position to pay a distribution. Now, the benefits of, sometimes I think some investors will wonder, why would I ever invest in a development deal? And I think, it's similar to real estate investing in many ways, where development deals can offer overall higher yields and higher returns because the capital appreciation often is a bigger component of the return, and you're taking what might be bare land and improving it by planting trees, planting economic assets there. But another factor is depreciable value. So of course you can't depreciate land, but you can depreciate long-lived assets. And so if we're planting new trees or we're doing capital improvement projects on a property, like maybe we're improving a well, or building a bridge to make the property more accessible for equipment to get from one parcel to another. All of those expenses or investments would be depreciable. And we do have bonus depreciation farmland similar to real estate. So there can sometimes be potentially large and meaningful tax savings through bonus depreciation and the depreciable value that developments offer. So that is one consideration for why an investor might consider a development deal versus a turnkey mature property that may offer near-term cash distributions, but may not have quite as high of a depreciable value over its lifespan.
Okay. Interesting. In terms of that bonus depreciation, I think it's like being phased out. It's like some of the Trump stuff, right? Can you go into that a little bit more, how that works?
I don't know if it's different in real estate, so I wouldn't be able to speak to whether it's being phased out or not. I only know the policies that we see in farmland, and in farmland we are able to depreciate 100% of development costs that were incurred in the year that the asset goes into service. So if we're developing a property for 4 years, we planted almond trees, and let's say we planted almond trees this year, and in 2027 we changed that asset to being in service, meaning it's producing a commercially viable yield. We would then be able to potentially depreciate and realize 100% of our development costs in 2027 that we accrued in 2023, 2024, 2025, and 2026. So that's the bonus depreciation that we see in farmland. I can't speak to anything that's being phased out in other parts of real estate because I'm not familiar with that, but that's at least what I'm referencing.
Okay, got it. Yeah, I'm not an expert either. I heard, I think maybe it was last year, was for 2022 was 100%. Now it's like 80%. It goes down 20% or something like that. Not really important, just kind of curious. But in terms of the exit opportunities, you're all looking to sell the asset or just do a refi, some liquidity events, or how's that work at the end of the, say, 11 years?
Yep. So our exit options and strategy is to, again, to really develop and execute on our value creation plan, and that can differ from one property to another. But part of our strategy is also acquiring properties that are in just one moment, I'm sorry. Part of our strategy is acquiring properties that are in close proximity. So these are properties that may be too small for an institutional investor to consider as just standalone assets, but too large for individuals who are looking to maybe add on to an existing property to purchase. So we actually see that as one of our competitive advantages and part of our acquisition strategy. We look for properties that typically fall between $2 and $15 million in value. This is a part of the market that we think is underserviced, and again, that's a reason behind that is because $15 million properties are too small for institutional investors, but often far too large for private individuals. So that's part of the market that we focus on, and it's a buy and build strategy. So if we acquire, say, 10 $5 million properties, all in a similar commodity group and in a similar area, and they have similar hold periods, when we're looking to sell those assets, we can look to sell the entire portfolio to one buyer. And an institution is going to be much more interested in, say, a $50 million portfolio of properties than they would in a standalone $5 million property. So that's one I would say key point of our acquisition strategy. It is to build out these portfolios and a buy and build strategy keeping in mind that at the end of our stay and hold period, we are looking to sell potentially to institutional investors who are going to want that larger scale and size.
Okay. Are there like, or other, like, what's kind of their profile of these institutional investors? It's good, like broad term.
I'm sorry, you cut out just at the beginning of that. Can you repeat that?
Oh yeah, I was just wondering if there's like certain private equity firms that specialize in this asset, or is it insurance companies, asset management arms, or who's usually buying them?
Yeah, insurance companies are probably one of the bigger, larger presences in farmland investing. And that's because it's an excellent asset class for insurance companies. They look at farmland as a perfect asset liability matching asset class. And so many of the large insurance companies do have either allocations to farmland, or many have their own internal farmland investment team. So, earlier in my career, I worked with PGIM, that's the investment management arm of Prudential. So PGIM, which of course offers many services, but I think everyone typically thinks of Prudential for their insurance in the insurance industry. Their investment management arm has a meaningful farmland investment arm as well. Beyond insurance companies, we see endowments and pensions in the space, both direct and allocating to third-party managers. Family offices, I think anyone following farmland, and you may have seen this, Mason, but Bill Gates is a pretty prolific farmland investor, and often will come up in the news that his farmland investment group, made a recent acquisition or had a recent sale or whatever it may be. And just because of his notoriety, that often gets a lot of attention. So ultra high net worths, family offices, pensions, endowments, insurance companies, those are the institutional investors that we see active in farmland today.
Okay, that's very interesting. And back to the kind of the niche of 2 million to 15 million in value, what does that look like in terms of just minimum acreage, or even like a range of acreage?
That's really hard to say, because acreage value can differ so much depending on where you are in the country. But I would say typically we're looking at several hundred acres upwards to maybe 1,000 acres. 1,000 being on the larger end, and often maybe that's like a bare land acquisition that we're developing. Several hundred being the norm and the average. And if you look at where we're seeing land values today, in Northern California, pistachio orchards right now have been selling at $60,000 plus per acre. So that's quite different than row crop land in the heartland, which there's so many areas that are sub 10,000 per acre, or even 7,000 per acre. So the acreage can differ meaningfully depending on where you are in the country, and if you're investing in row crops or permanent.
Okay, yeah, very interesting. But even something as small as like 20 acres or 50 acres, it's just too small to just be able to do, huh?
So I mean, it depends again. So if we're looking at say a 50 acre mature pistachio block, that's something that we would consider. That's a $3 million deal in today's market. So it ultimately depends on whether it's a turnkey asset, if it's a specialty commodity. But I would say most of our properties or acquisitions we're looking at probably a minimum of around 50 acres, but often 100 plus or several hundred acres. And really nothing that's north of very atypical to see something north of 1,000 acres.
Okay. Yeah, it definitely helps me understand more. That's really helpful. In terms of like finding someone that would potentially lease the land from you, how would you go about doing that? Say for a row crop.
Yeah. So how would we find our tenant?
Yeah.
So that's where being active in the industry and having relationships is really important. We're seen by many prospective tenants, and so we have tenants reaching out to us all the time to inquire about new acquisitions, or if we have opportunities for them to lease. So that that would be one certainly one tool that we use. And then in addition to that, our our operating partner network. Our operating partners, if they're not servicing our assets for us directly, they may be interested in leasing the assets, for their operating company. So often through our operator networks, we'll get referrals for potential tenants. But more often than not, I think it's a referral based and relationship based industry. So we're typically finding our tenants through word of mouth, or they're reaching out to us. With any tenant, of course, we go through an interview process. So we do interview our tenants and do due diligence on the tenant before entering into a leasing agreement. And then particularly for tenants where we're looking to do multiple transactions. So we have a couple of groups that we work with for many deals, and we've done over a dozen with at least one that comes to mind. If we're going to be leasing, 12 or more different properties to the same tenant, obviously we're going to go through a very rigorous diligence process and get to know that tenant really well before getting into that deep of a relationship. So, I think all tenant relationships, whether the tenant finds us or we find the tenant through a referral network or whatever it may be, there's certainly diligence involved, and that diligence becomes, I would say, more rigorous if we're looking to do multiple transactions with that tenant.
Okay, very interesting. Yeah, I just asked because occasionally, I would come across some land, like there was 26 acres by San Antonio, for example, and there was actually someone already leasing and doing row crops there. I don't know what kind. But I was just kind of curious if I ever came across that situation, how that might work, because I would have no idea where to find a tenant.
Yeah, of course. Yep. And that's another reason why I think farmland has historically been somewhat inaccessible to investors. Even if an investor had the resources required to outright purchase their own property, odds that they know how to farm or would be interested in farming, or obviously are not very high. And so even if you do purchase a very nice productive block of cornfield in Illinois, if you don't know who to call to lease that to, how are you going to find someone to generate rental income for you on that property? So that's a big blocker as well. And historically it's been an obstacle for investors who want farmland in their portfolio. But even if they have the resources to acquire their own piece of farmland, getting that tenant in place can be challenging, and that's something that we try to solve through our investment management services.
Okay, that makes a lot of sense. We're running out of questions here, but I think on everyone's mind is what happens if the economy goes south? Like, how would farmland perform in a recession, or how did it perform in the last recession in like 08, 09?
Certainly. So I think I would definitely direct anyone interested in finding out more about that to our website, farmtogether.com. We have a white paper where we actually do a pretty deep dive analysis on how farmland's performed in multiple periods of macro instability and also recessionary periods. So we looked at the Great Financial Crisis as one, but other instances as well. And I think the most prescient in my mind is actually COVID. Obviously I think the jury will always be out right now on whether we're going to have a recession, or we've lived through a recession, or what this period has been. But farmland's performed really strong in the past couple of years, despite there being obvious logistical challenges, obvious supply challenges. We've seen really tremendous appreciation. I would say categorically, particularly high in row crops, but we're also seeing appreciation that's meaningful in permanent as well. We use a benchmark called the NCREIF index, and the NCREIF is an index that many real estate investment firms look at for comparison benchmarks for other sub-asset classes in real estate. They also have a farmland index, so we use the NCREIF farmland index. And that index has, over the past 31 years, I think posted a 10.7% average annual return with I'm going off memory, so I may be wrong. Please check this, but I think an average volatility of 6 or 7%. basically the inverse of the S&P 500. So much more yield with much less risk. So there were, I think actually just thinking about performance one more time, the thing that has always stood out to me is the fact that there's very little drawback and drawdown in farmland. So if we look back to 1991, 1992, when this index was first published, that gives us, roughly 120 to 130 different quarters to evaluate. And of those, call it 100, let's say 125 quarters, there have only been 2 in the index that have produced a negative return. And one was back in, I think, 2000 or 2001. The other was, I think, the first or second quarter of 2022 during COVID. But that's a pretty stunning result, I would say. I can't think of any other asset class that over 125 quarters has only had 2 quarters of negative performance. So, I would say that looking at farmland over recessionary periods and unstable economic periods, it does tend to perform well because it's a strong inflation hedge. Agricultural commodities are used all over the place in different supply chains, not just food, feed, and fuel. They're in fibers. They're in so many different CPG goods, and then the capital appreciation and preservation of real assets is something that has proven to be fairly resilient as well. It is a truly uncorrelated asset class, and we like to think of it almost as farmland as you're sort of playing for more singles and doubles versus like a grand slam that maybe. If you're doing a private equity investment or something that's has more risk, a venture capital investment, that's more of a play for a grand slam. Farmland has, it's a capital preservation game, singles, doubles, income return, capital appreciation. I think that has been the nature of the asset class. Some may find that boring, but in our view, especially in these uncertain economic times, we think it's a great addition to many portfolios.
Okay. Yeah, that makes a lot of sense for a number of reasons. It's really interesting. What's usually the equity multiple on these types of deals?
Typically around 2 to 3 times.
Okay. Yeah, kind of back to your point, not looking for like a 10x or 20x multiple on these deals.
Yeah.
But that makes sense. I mean, obviously there's a lot of other real estate private equity deals, multifamily or whatever, that kind of aiming for that 2x equity multiple over like 5 years, for example. But every asset and every deal is different, so it all depends.
The other thing that actually that's interesting about farmland that many don't know, even in real estate, is that it is a 1031 eligible asset class, and so it is considered like-kind property. And so for real estate investors who are looking to rebalance their real estate portfolios, or obviously there's parts of real estate that are under a little bit more stress right now in this economic environment. If you're looking at potential 1031 exchanges, I think the options are often pretty vanilla, and they look alike. There's only so much difference between a multifamily investment opportunity and in northern Texas versus Colorado, right? But farmland does qualify as like kind, and so if an investor was looking to utilize 1031 proceeds and they wanted a different option and they want to diversify maybe a little bit outside of commercial real estate or residential real estate, I would definitely recommend looking at some options in farmland.
All right, perfect. Yeah, that reminds me of the last question. I noticed on your website, if someone wanted your company to kind of like source the land and do kind of a do it for me service, it mentioned like $3 million minimum investment, which is different from just investing, say, 50,000 into an overall syndication. So why 3 million? Just curious.
Yeah, so we have a few different products. Our crowdfunded deals, the minimum is 15,000, 15. We have an open-ended fund with a minimum of 100,000. That's a diversified option. And then we offer tenant and common interests, which are 1031 eligible. The minimum there is 500,000, and then we offer what we call bespoke or separately managed accounts, and that's the highest minimum at 3 million. And the reason for 3 million is because, again, when we look at that valley of deals that we target, we're looking for deals that are in a range where we think we can be very competitive and we can deliver on the capital appreciation of the asset. And deals that are much smaller than 3 million, often tend to be very competitive at auction, and you're dealing with multiple buyers, and it's harder to deliver on that capital appreciation. Whereas once we get into the $3 million plus range, all the way up to about 15 million, we think that we're in a spot that we've identified as a lot of opportunity, and there tends to be outsized capital appreciation potential there. So that would be certainly part of it. I think the other part of it too is because we specialize more on the permanent side, the land basis tends to be much higher. So we're not, we're less often looking at $5,000 per acre row cropland opportunities, and we're more often looking at $30,000 an acre, 40, 50, maybe even $60,000 per acre specialty commodity with much higher margins, but obviously it's a bigger ticket just by virtue of the fact that the land basis is higher.
Okay, and does that 3 million primarily go to the land acquisition, or is it like 2 million for the acquisition and 1 million for the setup and everything else?
Yeah, great question. Typically, a good chunk of that is for the acquisition, and then we do have to maintain a working capital balance. I wouldn't say it's necessarily 2/3, 1/3. I would say more often if it were that breakout, if it were a $3 million deal, we're probably assuming it's a mature property, the purchase price would probably be in the ballpark of like 2 to 2.5 million. There might be a need for improvements. Maybe we need to improve a well or whatever it may be. So that might be a couple $100,000. And then we always maintain a bit of working capital, obviously just to continue operations. So that would be the breakout.
All right, perfect. Well, we're coming up on the hour here. I think this has all been really helpful. If people want to get in touch with you or just invest in one of the offerings, how would they do that?
I would definitely check out the website at farmtogether.com. Ton of resources there, white paper on farmland performance throughout multiple decades and multiple periods of financial instability. So I think it's just a great resource for anyone looking to learn more about farmland as an asset class. And that I'm more than happy to connect with anyone who's interested in farmland or learning more about Farm Together. My email is david@farmtogether.com.
All right, perfect. Thanks a lot, David. This has been very interesting, very helpful. Hope to do it again sometime. I hope that you enjoyed it and people got some value from it. Thanks again.
Thank you, Mason. This was a lot of fun. Appreciate it.
Hey guys, I appreciate you taking the time to listen or watch this episode. As you might have noticed, we don't run ads, but what I would like you to do is just subscribe to our YouTube channel. That would help us out tremendously. You don't even have to leave a review, but if you do feel like you would gain a lot of value from this episode, feel free to share it with your friends and comment, like, subscribe, all that. But subscribing to YouTube would be what helps us the most. That's the only thing I ask. Thanks a lot. And if you do want to get in touch with me, feel free to email me at mason@scalablerei.com. Thanks a lot.